Hello, I'm Katrina M. Craft, and you've just tuned into the Craft More Cash podcast, where finance meets innovation and strategy becomes reality. With over 2 decades navigating the twists and turns of accounting, tax, and business strategy, I've had the incredible opportunity to work with startups and Fortune 500 companies alike, crafting pathways for businesses to grow and thrive. I've tailored my expertise to serve the unique needs of industries ranging from real estate to creators to marketing and beyond. I'm on a mission to equip individuals with the financial savvy they need to succeed. Through my Wealth Intelligence course, I'm all about breaking down complex concepts into actionable strategies for business owners. Welcome to Craft More Cash. Let's make wealth building simple, fun, and effective. Ready to transform your financial journey?
Hello, I just want to welcome everybody to the Business Tax Planning Strategy Workshop. I am so excited that you're taking time out of your schedule because I know everyone may be thinking about taxes now, and it's so important to think about tax planning, especially as it relates to your business. So today, I just want to give you insight about business tax planning strategies that you can take right now to really impact your tax return and your business to gain more profitability. How many of you are satisfied with the taxes you pay? Okay, I don't hear anybody saying yes. Most people feel like they are overpaying their taxes. And in reality, there's a study that shows 80% of business owners do overpay taxes. So today we are going to talk about how you are not in that 80%. We want to get you in that 20% where you are paying lower taxes. Are you confident that you're taking advantage of every available tax break? Well, I don't know if you know, but the tax code is over 2,500 pages. And when you add all of the supplemental code sections that explain more about the code, it's up to, some people say, 60,000 pages. So who has time to learn all of that? It's really someone that is involved in looking at tax breaks, looking at tax strategies, and making sure that we are communicating that information to the business owner. The next question I want to ask: are your tax and investment advisors giving you proactive advice for saving on your taxes? That means you're getting information before tax time. Once you go to your tax preparer and it's April 10th, 5 days before tax deadline date for individuals, it's actually too late. That's not proactive advice. That is reactive advice. You are just giving information that is already done. It's nothing that the tax preparer can do to help you save more money. So the first mistake is failing to plan. There's nothing wrong with the strategy to avoid the payment of taxes. The Internal Revenue Code doesn't prevent that. And this comes from a Supreme Court justice. So remember, you can prevent paying taxes, but you have to know the rules. In fact, the Internal Revenue Code is set up to help business owners. That's why I really advocate for small business owners and business owners, because I know that unless you know how to utilize the tax code to really maximize tax savings in your business, you're going to pay more taxes than you legally should. I do assist individuals with tax savings plans, and I assist business owners to improve their revenue, improve their profitability, and better manage their cash. But remember, I did mention that if you are not a business owner, the tax law may not be in your favor. So I work with business owners and then the individuals who have businesses. A little bit about me. I am an entrepreneur at heart. I enjoy working with entrepreneurs and small business. In 2002, I actually took the dive and I began my business. What I didn't realize, although I was a CPA, there were some things that I had not put in place in my business. So I depended on one contract, and that contract gave me 80% of my revenue. 2 years later, that person decided they no longer wanted to work in the business. That left me over $100,000 in debt. What was I to do? I had just purchased a home. I had just started my business, and I really was searching for the tools that I needed to grow my business. And that's how I came up with my system that I have now. I was able to pay off all of that debt in 3 years and grow my business using tax advantages. I am a certified public accounting firm, like Angela mentioned. It is CM Craft PLLC. I also have a business called Craft Entertainment CFO, and that's a financial business management company that I started in 2016. And I work with entertainers, I work with people in digital media, online businesses, and I love that aspect. It's always changing, but I also work mainly with companies that are dentists, medical consultants, and people that really are providing services. That is who I work with. I also want to just mention to anyone that's out there, I have customers who are, well, looking to be a client of mine, and they may have a restaurant. I really advocate for people, if you're starting a business, find a CPA, a bookkeeper who understands your business. Every business is not alike. Every industry is not alike. So you really need to find someone who understands your business. It's going to be imperative that they understand your numbers and can guide you on different types of tax strategies that are specific to your business. So today, let's talk about the agenda. We're going to talk a little bit about business entity structure. That means how you're formed. We're going to talk about business deductions. What type of business deductions can you take? We're going to talk about the legal structures, how they are taxed. So how are your businesses taxed? And we're going to understand how your individual tax and business tax work together. It is important that you understand strategy on why it's important that you understand what you do in your business and how it impacts your individual tax return. Why tax planning? That's a great question. So tax planning really means looking forward to minimize your tax, not just recording history. Again, at the beginning, I kind of talked about why you want a proactive tax preparer or proactive advisor that's going to really help you and look at what are your goals. What do you want to accomplish in your business? Do you want to pass it to children or family members? Do you want to sell it? Do you want to grow it really fast and then maybe wind down the business and then just vacation the rest of your life? Well, that's important that you understand what your end goal is when you set up your business, you establish your business, because everything we do in the tax strategy, we're looking forward to really what is your goal. We're just not recording history. I really don't want to work with a client who at tax time says, I haven't had time to get to you all year. Here's my box of receipts. It's really too late for me to help you. And I really know that the code and the tax code, when you know how to use it, it really can impact your bottom line. Let's talk about structuring for success. This is talking about how you structure your business, entity structure. There are different types of structures. There's a sole proprietorship, a partnership, and a partnership can be general and limited. There's corporations, which are S Corps or C Corps, and there are limited liability companies. So we're going to talk a little bit about each type of company so that you understand why these are important to understand, but you need to know that every structure is not the right one for you. Just because your neighbor said they did an LLC that may not be the right structure for you. So you really need to understand the tax strategy behind why you may choose each one of these entity structures. So let's talk about first the C Corp. The C Corp is a structure that's all its own. It has its own tax return. It has its own reporting. And if you are involved in the C Corp and you're providing services to the C Corp, you would be an employee of the business. Or you may be on the board of directors, and in that way you can also, get paid. But as an employee, if you're working day to day in the business, you would be an employee of that business. So the only way that the C Corp would get recorded on your tax return is when you have a W-2 that gets reported on your individual tax return. Otherwise, the C Corp has its own tax return and its own tax rate. So we are going to look at the tax rates for a C Corp. The next type of structure is an S Corp. An S Corp means a small corporation. There are different guidelines that you have to meet in order to become an S Corp. Not all corporations can be an S Corp. So you need to understand those rules. Now, an S Corp, you will get a report, which is like a K-1, that reports the net profits or losses from your corporation, your S corporation. That gets reported on your individual tax return. So that means that the income or losses that are from the business will be on your individual tax return and will have your individual tax rates. That's why it's important to understand, is it best for me to be a C Corp, which has its own rates, or do I want S corporation losses and profits to record on my individual tax return? Also in an S corporation, if you're providing services and working in the business, you also need to pay yourself a salary and you will get a W-2. So with the S Corp, you're going to get a K-1, which shows your net profit or losses, and you're going to get a W-2 from your business. That is very important. I've seen a lot of clients who have come to me new and they have not reported S corporation wages. That is a red flag for the IRS. They look at that line item. There's a particular line item that says, do you have wages for the owners? Do you have wages? And it also will say, if you make over a certain amount, we have to list how much wages you have paid yourself and the ownership that you have in the business. So the IRS definitely wants to make sure that S Corp owners are reporting wages. Partnership return. Partnership returns can be limited or general. General partnerships, I do not recommend, because if someone wants to sue you, general partnerships has no liability protection. General partnership. That's why if you want to do a partnership, which means you have more than one person that are owners in the business, I suggest a limited partnership. That will limit your liability. Your liability means if someone wants to come after the partnership, you personally will have limited liability on that. Also on the partnership, some reasons why people do like partnerships is because a partnership can have a 50% owner, but just because you are a 50% owner, it does not mean that's how you have to allocate your income and your losses. The allocation just needs to be a valid reason on why you allocate. Let's talk about the sole proprietorship. A sole proprietorship is a business where you are saying, I may be a DBA, so doing business as. You have decided that you do not want to be a C Corp, S Corp, or partnership, and partnership has its own tax return as well, and it flows to you, to your personal tax return in a K-1, just like an S Corp. It has its own tax return, and it flows to you on your individual tax return in a K-1. But on a sole proprietorship, You are not operating with a separate business entity. Your sole proprietorship means that you're going to prepare your business expenses and your business income on your personal or individual tax return. It will go on a Schedule C. I recommend, if you're having a sole proprietorship, you can keep being a sole proprietorship up to a certain income level. After a certain level, it really is best if you convert and you become an S Corp, C Corp, or partnership. And again, it's all about the strategy. It's all about what are your goals? What's your industry? How do you operate? And doing the strategy, that's when it can be determined what is the best structure for you. So you may be saying, well, what about the LLC? Where is this LLC? I don't see it anywhere on here. Well, what you do need to know is that an LLC is not a recognized structure by the IRS. You like, what? What do you mean? Well, the LLC is a structure at the state level. Each state has its own LLC rules and protection. So that's why it is important to understand the LLC and the rules in your state, because one state has stronger LLC rules and protection than other states. Is very important. But the LLC can be taxed as a sole proprietorship, a partnership, an S Corp, and a C Corp. A lot of times I ask prospects, what type of business entity? And they may say a LLC. And I say, well, how are you taxed? A lot of times attorneys are not, giving this information, or if you have set up your LLC on your own, you may not recognize that you can choose sole proprietor, partnership, S Corp, or C Corp structure. If you do set up an LLC and it's one member, LLC, if you are owner, is called a member, you will default automatically to a sole proprietorship in the eyes of the IRS. So just know that if you set up an LLC and you say you're a single member, you are going to default to sole proprietorship. If you file as a LLC and you have multiple members, you're going to default to partnership. That may not be the best thing for you. Defaulting may not be the best. So you really need to understand, if you're setting up an LLC, you really look into which structure is going to be the best for you. So let's talk about business taxes and explain how business tax work. First, you're going to add up all your income from all of your sources. Then you subtract your cash expenses. Those are going to be expenses that you actually pay by cash, credit cards. So when they say cash, is just not, the dollar. It could be any type of credit card that you're using to pay for expenses along with cash. Subtract non-cash expenses. So non-cash expenses are things like depreciation. That means you've bought a fixed asset and you may not deduct the whole cost of it. You are going to get depreciation, which is like a portion of it every year that you can deduct. So that would be an example of a non-cash expense. Then you're going to calculate your tax. So in the C Corp, we talked about how the C Corp has its own tax. You would calculate that based on the C Corp's rate, or it's going to pass through. And again, remember when we talked about pass through, that's your S Corp or your partnership tax return. It's going to pass through to your individual return. You're also going to be able to deduct any tax credits, or you pass that through. So that's how the tax return for businesses work. Let's look at what was happening. So in 2018, there was a big tax change, and we are probably going to have another big tax change. So the change in 2018 was a change that Trump put in place and voted to pass. And now Biden is looking to make changes as well. So there may be changes coming very soon to taxes. But in 2017, before the tax situation and the act passed, we had different rates. And this is for C Corp rates. We had 15% all the way up to 38%, and then it would go back to 35%. So Depending on your business, if your business made $50,000 and you were in the C Corp, you would pay 15% taxes. So this is just a snapshot of what it was in 2017. The reason I show this, is because now that Biden is in office, some of these changes that happened in 2008 may be reverted. We don't know what's going to happen. So we do want to look at 2017 and what happened prior to the 2018 Tax Act. Now in 2018, C corporations have a flat tax rate. That means it doesn't matter if you make between 50,000 and what's this, 18 million, you will have a flat tax rate of 21%. That could really hurt small businesses. Just look, from 0 to 50, 21%. But in 2017, you would have paid 15%. So it is important to understand that you always have to look at your strategy. You need to understand the tax changes and what's happening, because that small impact, if you were a C Corp, now you could be paying 21% tax instead of the 15. It's very important to always keep up. There were also some other changes that I'm not going to even get into because it's so complicated, that like personal service companies used to have its own tax rate. And then there used to be a corporate AMT tax. So those are just advanced tax strategies that I'm not going to go into. But the main thing is just to understand right now, if you're a corporation, it's 21%. And most likely this would go up. They've been talking about maybe 22 or 23%. And so we just have to wait until Biden passes the new tax act to see what that will be.